This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
In our studies of IHT so far, we've seen, in fact, all of the computations that we may be called upon to prepare by the examiner. They are, firstly, in lifetime, if there's a transfer into a trust, we label it as a CLT, a chargeable lifetime transfer, and we attempt to compute the lifetime transfers chargeable when made, computation. It's headed lifetime transfers chargeable when made. We only put CLTs to it. We then check out what was the available nil rate band at the date of the CLT when it was made, and then if we go above the available nil rate band with any such CLT, then what that means is that the excess is going to be taxed at either 20% if the tax is to be paid by the trustees, it's referred to as a gross transfer, or if it's paid by the donor, then it's a 25% tax charge, and that's referred to as a net transfer. Now, having dealt with one CLT, you may go on and have to deal with another. The question then, therefore, is what amount of nil rate band is still available when dealing with the second CLT. And that, of course, depends on not just the amount of the first CLT, whether it's above or below the level of the nil rate band, but also the timing of that second transfer. We know that the impact, the cumulative impact of that CLT will remain relevant for the taxpayer for 7 years. So if therefore you wait for more than 7 years before making the next transfer into a trust, you can start all over again with the then available nil rate band. But we've got to remember, IHT is this cumulative donor-based tax. Now, once we've done the lifetime transfers chargeable when made comp, we can then look at the lifetime transfers chargeable on death computation. How do we deal with it? Look at the date of death, go back 7 years, and then start to list out from the earliest first and then onwards the CLTs or PETs that took place within the 7 years before death. We then use the nil rate band in force at the date of death, and once it is used up, any remaining balance of chargeable transfer is going to be taxed at 40%. If there is a tax charge, then check out the date of the chargeable transfer, the lifetime transfer, as compared to the date of death. Now, hopefully you know where this is going, because if, although sadly you didn't survive for 7 years, the taxpayer did indeed survive for at least 3 years, then any tax charge that arises may be reduced by taper relief. So in that way we can compute the amount of tax payable on death, subject to one further reduction. Now this, of course, is only applicable to CLTs that, having firstly applied taper relief, then you would deduct any lifetime tax that had been paid in relation to that CLT. The deduction of that lifetime tax can serve only, of course, as to reduce what would have been any additional tax charge due. The best you can hope for that it eliminates any additional tax due. It never will create a repayment there. And having computed the lifetime transfers chargeable on death, then you can deal with your chargeable estate, which you may be given the figure as I have given to you in previous examples, or you may be told the contents of the estate. You list out those assets, again watching out for a deduction for a mortgage, for example. Is it endowment mortgage, is it interest or repayment mortgage, as to whether you don't or you do make deductions from the value of the property. Looking at life policies, it's the proceeds that were payable, not the market value at the date of death. List out the assets, take out any liabilities due to be paid by the taxpayer, and if there are any exempt legacies, then any bequests that you've made to your spouse or civil partner, they will also serve to reduce that chargeable estate. In calculating the tax on death, whether it's on the lifetime transfers chargeable on death or thereafter on the chargeable estate, we do of course have to be aware of the available nil rate band. There we have to see whether or not the taxpayer is now a widow or widower and had left to them some part, if not the entirety, of their original spouse's estate to see whether there was any unused nil rate band that would have transferred from the sadly predeceased spouse and now would be available on this spouse's death. That needs to be done before you can do any of your IHT calculations on death, whether that is for lifetime transfers chargeable on death or thereafter the chargeable estate at death. What we mentioned at the end of last time, and you see now on the screen in front of you, is that in working out for any lifetime transfer, what is the amount of chargeable transfer in relation to the gift made, then away from any transfer of value that we have initially computed, we are able to deduct various exemptions. Indeed, some of these exemptions may be in full. There may be a complete exemption in relation to the entirety of the transfer. So what are the ones that we need to know about now within our syllabus? So, looking here at page 144, section 7 of our chapter 24 on IHT, the first one we're introduced to is one that we, albeit briefly, mentioned in an earlier lecture. And that is that each tax year a taxpayer has available an annual exemption. But it's not a huge amount. It's the first £3,000 worth of any gift or gifts made. Each tax year is exempt. So the annual exemption is a £3,000 figure. Usually, like with annual exempt amount, the CGT, like with the personal allowance in income tax, the deductions are available for a tax year, but it's available on a basis of use it or lose it. So if you don't use it, like you don't have any capital gains in a tax year, so you don't use your AEA, your annual exempt amount, then tough. You'll have another AEA next year, but you don't get to carry forward any unused such exemption or personal allowance. Well, here with IHT, there is an exception to that rule. That is that any unused annual exemption from a tax year is carried forward one tax year, maximum one tax year. And then when you carry it forward to that next year, it is then only used after that year's own annual exemption. So when looking at lifetime transfers in the tax year, we deal with them chronologically, first come, first serve. We will firstly apply the annual exemption of that, the current tax year, and once it is used up, we then look to use up, if available, any unused annual exemption brought forward from the previous year. As we said, the exemptions allocated on a strict chronological basis within the tax year, as we'll see in a moment's time with illustration 10. Now that's the main one that will routinely apply. Again, just be careful about reading a question as to whether or not it says for you to ignore annual exemptions. It is a possibility. Make sure you've read the requirements carefully. But other than with that statement, there is an annual exemption available each year, £3,000. If unused or any part of it unused in a tax year, you can carry forward for just 1 year, the use after that year's own annual exemption. Next exemption, marriage exemption. Now, this is another one where there's a finite figure. There is a level of marriage exemption. Now, to begin with, it might sound odd because you remember that transfers between spouses or civil partners are exempt. What we're looking at now is a gift in consideration of marriage or civil partnership is exempt up to certain limits. Now, this will depend on the relationship of the donor to the donee. So, to begin with, for each of the parents. So, if the donor is a parent, their child is getting married, so a parent of the bride or groom, then the first £5,000 is exempt. So, the first marriage exemption we need to know, £5,000, a gift by the parent through to their child, who happens to be either the bride or the groom. For remoter ancestors, for example, we're now dealing with a grandparent, then there's a marriage exemption of £2,500. So if grandfather or grandmother makes a gift to grandchild on the occasion of their marriage, then up to £2,500 is exempt. Strangely, you might think, and going back to the introduction to this exemption and what I said then, and for the parties to the marriage as well, parties to the marriage themselves, the exemption is £2,500. Again, we may think it odd, thinking, well, transfers between spouses, civil partners, are exempt. But we're talking here about gifts that take place prior to the marriage. So guys, you'll be very pleased to hear that you can spend £2,500 on the diamond engagement ring there and have no worries about any inheritance tax in relation to that transfer. I'm sure that's a compelling reason to spend high there. So £2,500 of marriage exemption, either grandparent or great-grandparent, to a grandchild or great-grandchild on the occasion of their wedding, or one spouse to the other or one civil partner to the other, prior of course to them becoming spouses or civil partners on the occasion of their marriage or civil partnership. There's then a general level of £1,000 of marriage exemption where you, the donor, make a gift to anybody else. So if it's not your child or grandchild, great-grandchild, if it's not your spouse there or spouse-to-be or civil partner-to-be, then anybody else, it's £1,000. Typical one there, you give to your niece or nephew on the occasion of their marriage, £1,000 worth of marriage exemptions. These exemptions, firstly marriage, if available, and then annual exemption or exemptions, are deducted from the transfer of value to compute the amount of chargeable transfer. So you have to firstly establish, if there is a working to be done, what is the transfer of value, but that is not necessarily the same as the chargeable transfer, the figure for the PET, the figure for the CLT, that will then feature in one or other or one or both of those IHT computations for lifetime transfers that we reviewed a few minutes ago at the start of this lecture. There are then other exemptions that will just be exempt full stop. Won't be a deduction, it will just be that amount is exempt. Firstly, small gifts. What is small? Up to $250 per donee per tax year. $250 per donee per tax year exempt. But if that limit is exceeded within the tax year, there's no exemption. So if, for example, in December 2015, a taxpayer makes a gift of £200 to their niece or nephew. £200. To begin with, £200 does not exceed $250, so we're thinking that the small gift exemption will apply. But if then, before the end of the tax year, so this was December 15, so by the 5th of April 16, the end of the 15-16 tax year, if the donor were to give to the same donee another £200, then the aggregate, the total for the year is now £400. That exceeds $250. There is no small gift exemption. Both of those gifts would be chargeable, but of course there may be other exemptions, like the annual exemption we've just mentioned, that are sufficient to cover them anyway. But the small gift exemption would not be available. It's £250 per annum per donee. Least likely of the lot, gifts for family maintenance. Any gifts made to maintain family members are fully exempt. Here, again, maybe your elderly grandparent or great aunt needs a carer and you pay for the carer there. Therefore, gifts for family maintenance are fully exempt. Normal expenditure out of income. This is the other one, other than small gifts, the other one that we're most likely to have to deal with. Probably not in a computational setting, but more in a narrative one, either as part of an objective testing question, where you've got to work out or state which particular transfers would be exempt and which would not, or as part of a discursive answer, maybe to a Section C question, when advising your client, the taxpayer, on ways by which gifts could be made in lifetime and you could avoid IHT. Well, here, normal expenditure out of income. Now, there's two main points for that. Normal. So, for this exemption to be available, the donor must show a regular pattern of giving. It's not just available on a one-off gift. So, for example, the taxpayer here might make regular Christmas presents or birthday presents there to the donee in question. Now, not only must it be normal, it must be out of income. So the donor must have sufficient income to maintain their normal standard of living. It's this that makes it difficult to be able to deal with a computational exercise unless you're pointed very seriously down this particular road. That is, that what the Duke of Westminster, who has probably about £8 to £10 million a year worth of income, what can come out of their income and what can come out of our income, more normal people, going to be very, very different numbers. But again, be aware, normal expenditure out of income will not be chargeable. Usually, we've got to use the numerate ones. Annual and marriage and small gift exemptions are the ones most likely to be tested. And so it is that we now have illustration 10 to deal with. Okay, we're told that we've got to compute the chargeable transfer figure for each of the following lifetime transfers. Right, first thing we need to do, because in an exam question we may not stop at just the chargeable transfer, we've then got to work out tax payable in lifetime if there's a CLT, tax payable on death, either if it's a CLT or a PET. So we need to label each and every lifetime transfer with one of three labels. If it was a transfer into a trust, it would be a CLT, I hope I hear you saying there. If it was a transfer to your spouse or civil partner, it would be exempt, I hope you're saying there. Everything else, of course, would be a PET. So let's have a look at what we've got and what we can glean from the first read through this list of transfers here made by the taxpayer. Right, we're told 7th of June 14, a gift to her daughter of £2,000. Gift to daughter, what type of transfer is that? That is a PET. So on the question page we can write PET next to that. Now we're told only other information down the bottom is that the gift on the 19th of September 14 is, oh sorry, that's part of the answer. Ignore that. Right, then I'll give you the answer too soon. Right, the only other thing we need to know is, were there any previous lifetime transfers? For this purpose we'll assume no, so you can then work out what exemptions, here primarily annual exemption, may be available. So this first transfer is the 7th of June 14. Right, if that is the first transfer that we've made, which annual exemption do we use first? We will use the current year. So that's AE 2014-15, annual exemption for 14-15 tax year. But the gift was only £2,000, so we use 2,000 of the 3,000 annual exemption. Next date, August 14, a wedding present to her son of 5,500. Wedding present to son, gift to son as per a gift to daughter, then that is a PET. It's a wedding present to her son, therefore marriage exemption. What's the marriage exemption when given to your child, your son or daughter? 5,000. I'll just write in 5k there. So it's a PET, wedding present to son, marriage exemption 5,000. But the gift was 5,500. So after having applied marriage exemption, we then look at any annual exemption. What date is this? It's August 14. We're still in the 14-15 tax year. Have we used up all of the 14-15 annual exemption? No, we haven't. So we'll use up a further £500. Obviously the marriage exemption has taken out 5,000 of the £5,500 gift, but we'll use another 500 on the transfer to her son there in August of 14, and that will remove any chargeability. 19th of September 14, a gift to her husband. Gift to spouse, don't care how much it is, that is an exempt transfer. So no more working to be done there. Not a question of any annual exemptions or anything else. That is an exempt transfer. 9th of July 15. Right, let's just draw a line between those transfers that were in the 14-15 tax year to now the transfers falling in the 15-16 tax year. That's the next three: July 15, December 15 and March 16 are all in the 15-16 tax year. So the next one that we've got, a gift to her nephew as a wedding gift. Gift to nephew, again, that is a pet. Wedding gift of £8,000. Wedding gift, so marriage exemption. Right, it's not to your son or daughter or grandchild or other party to the marriage there, so in which case it's anybody else, so that's a marriage exemption of £1,000. Now this is the first transfer in the 15-16 tax year. So far as the 15-16 tax year is concerned, we can use up now all of our annual exemption for 15-16. That's £3,000. Remember, the pet is valued at £8,000, marriage exemption 1, and now the AE for the 15-16 tax year is a further £3,000. This is 15-16. Having now used up all of the 15-16 annual exemption, remember, you could carry forward an unused annual exemption from one year to the next year. So, having now used up all of the current year, 15-16, do we have any unused annual exemption brought forward from 14-15? Yes, we do. Now, what had we already used up? We had used up £2,000, followed by a further £500 on that wedding gift there. So there's just a further £500 of the 14-15 annual exemption to utilise here. So quite a lot going on that transfer. Firstly, a marriage exemption, then all of this year's annual exemption, followed by the remaining £500 unused annual exemption from the previous year. On we go, nearly there. 25th of December 15, gifts of £200 each to two friends as a Christmas gift there. Now check out, was the next gift also to the same friends? Have there been any previous gifts this year to those same friends? No. So the total for the year is £200 each. That therefore means that that is exempt. It's covered, of course, by the small gifts exemption. That is covered by the small gift exemption. Finally, March 16. What type of transfer is that? Gift to a trust. Gift to a trust is a CLT. We know, of course, the value. It's £100,000 there. What exemptions? Well, do we have any unused annual exemption from this year? No, we don't. Already used up on the first transfer, the wedding gift to the nephew, and we've used up all the remaining annual exemption unused from the previous year, so there's no annual exemption. Clearly there's no marriage exemption. That's it. Therefore, there'll be no exemptions to deduct. The chargeable transfer will be £100,000. This is a CLT. Now we're told here, as we start the answer, about the gift September 14 is exempt, transfer between spouses. December 15, that was the small gift exemption. Then for anything that is either a pet or a CLT, this is the working that you do. Now, this is the main object of this part of the lecture, the ability to go from a transfer of value figure, which is always your top line, down to the figure of chargeable transfer, and it is those chargeable transfer figures that would then feature for a CLT, such as this one, in your computation headed lifetime transfers chargeable when made, and of course potentially lifetime transfers chargeable on death. And the chargeable transfer in relation to pets, where there is one, that's there, that of course would only go into the computation headed lifetime transfers chargeable on death. Now have a little look at how we've laid this out. We've dealt with each transfer chronologically. So the first transfer of value, £2,000, the gift to the daughter, covered by the annual exemption of that year, 1415. On to the next pet in August 14. That was a wedding present there, so we got the marriage exemption before then using 500 of the remaining 1,000 annual exemption. We'd used 2,000, 1,000 was unused, we used 500 there. On again then to the third and final pet, July 15, transfer of value 8,000, we said marriage exemption, just 1,000 this time, the annual exemption for the current year 1516, and the remaining balance of the 1415 annual exemption still unused, a mere 500. That does therefore give us a chargeable transfer, and of course on the CLT from March 16 we already know that that's going to be the £100,000 figure. Again, have a little read through, make sure you're happy with that working, because that is a working that you're very, very likely to have to do in answer to some part of an examination question on IHT. So we list out the pets and CLTs in chronological order. We state the date and what they are at the top, as you see there. We put in firstly the transfer of value figure. Potentially you may have had to have calculated one of those, like remember with unquoted shares. We then take away exemptions, annual before marriage, and of course make reference at the bottom of the note or working about any transfers rather that were just exempt, end of story. So have a little read through that note, that working there, please. So pause for a moment and then we'll continue on. Okay, well it's summary time now, bring it all together time, with section 8 our approach to exam questions, or as we should now say, our approach to a section C examination question. Now again, we could have a similar section B type of question, but there specifically of course there will be individual objective testing questions which say, I want you to calculate this, I want you to compute that, I want you to tell me an answer to this particular narrative question or whatever there. So this full extent of this particular exercise would only be dealt with on a section C question, but parts of this would need to be done to be able to answer questions in section B, or even indeed in section A. So in an exam question the following approach should be adopted. First of all, analyse your lifetime gifts. If there are exempt transfers, state that they're exempt. This is assuming a section C question here. State that they are exempt. Then in relation to pets and CLTs, point 1, compute the chargeable transfer figure for each lifetime gift, like we've just done in illustration 10. If you do have a transfer into trust, then the second point, if there's any CLTs have been made, then we've got to do our computation for lifetime transfers chargeable when made. We need to prepare that computation. Again, remind yourself of what that looks like. 2 columns on the right hand side of your page, gross transfers and IHT. Down the left hand side we will record just the CLTs, or maybe just CLT. There may be just one, but maximum 2. We will record them. To compute any tax payable, it needs to be determined who paid the tax. Is it the donor or donees? Remember, the donees, that's the trustees of the trust. Otherwise, we won't be able to determine the tax rate to apply to any amount of the transfer that goes above the nil rate band. Until you exceed the nil rate band, there's no question of who pays the tax, because there is no tax. There's no question of, is this gross or is it a net transfer? Is it gross and therefore 20% tax rate? Is it net and therefore 25% tax rate? Because until you exceed the nil rate band, there's no tax. But when you have exceeded it, that's when we need to know who is paying the tax, donor or donees. If it's the donor, 25% tax charge. If it's the donee, the trustees, 20% tax charge on the part of that chargeable transfer that exceeds any available nil rate band. Thirdly, any lifetime transfers, CLTs or PETs that fall within the 7 years of death are now included in the next computation. What is it headed? Lifetime transfers chargeable on death. Again, we've seen that in illustrations 7 and 9. Go back and look at it. Head it up, this time with just a couple of columns. So when lifetime transfers chargeable when made, yeah, we need the gross transfers, we need the IHT, we also need a little working column as well, a little inside column. But on this one, lifetime transfers chargeable on death, we only need the two columns, gross transfers and the IHT, the tax column as well. Now, what will be included on it, as we said, CLTs to be chargeable now potentially to additional tax, a second charge, and PETs to be charged for the one and only time. But they'll only be charged to tax if they fall within 7 years of the date of death. Remind yourself, go back and remind yourself of how we did that. Again, using up the nil rate band in force this time at the date of death. When we go above the available nil rate band, then 40% tax rate is then applicable. Against that tax charge, there may be taper relief if you manage to survive for at least 3 but not 7 years. And if it was a CLT, then any lifetime tax would also be deductible in deriving, if there is any additional tax to pay on the CLT. Only once that has been done can we then move to the charge of estate. That basically was your listing exercise, and reason why it comes last is we need to know from the previous computation whether any nil rate band is still available to go against the chargeable estate. To know then how much that is to be taxed at a nil rate, and how much then of the estate is to be taxed at the full 40%. In short exam questions, not all of the above steps may be necessary. Now, of course, that would include not just a question of a small section C question, one that's got a bit of IHT and a bit of something else in it there, i.e. the 10-mark question. We know the two 15-mark questions, one is on income tax, one is on corporate tax. That is cast in stone, that will always be. But elsewhere, of course, if it's objective testing questions, individually in section A, or put together as requirements on a basic core piece of information in section B, then we're going to be limiting our exposure as regards the steps that we maybe need to take. Or it might take us through, in terms of the questions, step by step, asking a question at each point there, at each step of the way. What we also said is that in addition to calculating the amount of tax that is payable, either in lifetime or on death, you might be asked to state by whom the tax has to be paid and by when. Go back and remind yourself of the basic admin there. Now, what that leads us to is example 1, which is the first full-blown written example indicative of what we might see within section C. So before we go into this, I would suggest again you make sure that you're happy with what we've done so far. What we'll then do, if you pause at this point, we'll come back, look at this, analyse the information in the question, and then, at least in this lecture, attempt to start putting that answer together. Whether we'll complete it is another matter within the available time. It may hang over to the next session there. But pause, check through before we approach this question. Okay, let's have a look therefore at example 1. Again, pretty much typical for a 10-mark section C based question. Now, as I said to you, it's probable that we'll see IHT in section B rather than the single 10-mark question in section C, but you never know. The only difference being is that instead of just a requirement here, compute the amount of IHT payable during Joe's lifetime and upon his death, we'd have, if it was section B, 5 individual objective testing questions specific to the information provided. But here, the full-blown exercise to do. Now, looking at the requirement, the amount of IHT payable during Joe's lifetime. That immediately therefore means that there must be a CLT or CLTs, and upon his death. So what are we told? Joe Kerr died, very appropriately, the April the 1st, 2016, leaving £250,000 to his wife, the remainder of his estate to his son. £250,000 to the wife. What do we know about that? That is exempt. So again, at least on a written question, on the question page, we can write that next to it. That is exempt. Leaving £250,000 to his wife, the remainder of the estate, that will be the chargeable part, to the son. At the date of his death, oh, pardon me, Joe owned the following assets. Now, be careful about the wording. I've used a term there rather than just his family home, his principal private residence. Now, the examiner uses this language to see whether you've understood the different rules in the different taxes. What he knows is he will now catch out students who are confused about the two capital taxes, what is CGT, what is IHT. Because if we see principal private residence, you might be thinking, oh, that's exempt. Now, actually, it isn't exempt CGT anyway, you get PPR relief. But none of those reliefs, none of those exemptions that you either see in CGT, or indeed, as we'll see in a moment, in income tax, will apply here. So we will include, listed out as part of the chargeable estate at death, his PPR, his principal private residence, his house, valued at £3,000. There was an outstanding repayment mortgage at the date of death, £80,000. That's a repayment mortgage, so yes, you will deduct that mortgage from the £300,000 value of the property. Then part of the listing exercise, holiday home, £140,000. Bank and Building Society deposits, £230,000. ISAs, market value £50,000. Don't go and say again, oh, ISAs, I remember that, they're exempt. Well, the income may very well be exempt. Any gains on maybe shares held with him may well be exempt. But for IHT, it's part of your estate at death, it is chargeable. Don't confuse the rules. So that will go in. 12,000 shares in Joe Limited, valued at £20 per share. More about Joe Limited a little later. A life assurance policy. Now, what was the rule on life assurance policy? We're told open market value at the date of death and proceeds that were received obviously following Joe's death. It's the proceeds that we pick up. That will allow you to list out assets. We also know from up here that £250,000 of the content of the estate will be exempt due to the spouse exemption, but as a prior deduction in getting the net estate, outstanding credit card bills of £6,000, that therefore is a liability due. At the date of his death also verbally promised to pay the medical expenses of £1,000 of a friend, verbally promised. This is not therefore a debt. This is not something that is owed nor legally enforceable. So in which case, no deduction there. And funeral expenses, £6,000, again we'll assume certainly that is perfectly reasonable. So funeral expenses will be deductible. We then get to the parts of the question that you'll actually have to start your answer with, but as we read through, again attempting to get as much information from the first read through of the question as we possibly can. We're now told about the following lifetime transfers. Now remember what we do. Firstly, we look at what type of transfer it is. Now this was a gift here to his son. Gift to the son, that will be a pet. It's a cash gift, so no problem working the transfer of value. It's November 09. Now, when did Joe die? Because as we know it is a pet, it will only be relevant in terms of calculating any chargeability, including on a computation, if this was made within 7 years prior to the date of death. Well, November 09, 7 years on from November 09, that would be November 16. Sadly, Joe didn't survive until then, died on the 1st of April 16, so yes, it is relevant. Right, it's a pet, cash gift of 40,000, so we know the value of the pet, on the occasion of his wedding. So that's to his son on the wedding. So that tells you marriage exemption. How much will the marriage exemption be? To his son. So that's a marriage exemption of £5,000. It's the first one made, the first lifetime transfer made. So we will have the annual exemptions available, firstly for the year in which it occurred, 09-10, and then as this was the first transfer, we'll have an unused annual exemption from the previous year, 08-09, to bring forward. So we got a marriage exemption at the maximum level of 5,000, 2 lots of annual exemption of £3,000 apiece. Right, on to the next one. 15th July, he transferred 405,000 into a trust. Transfer into a trust, let's get rid of that there. Transfer into a trust, that is a CLT. And paid the IHT due thereon. That tells you that it's a net CLT. Fairly obviously, at 405,000, we're going to exceed any available nil rate band, either then or indeed now at the date of death. In fact, in both cases, it's going to be £325,000. 1011 there are 1011 our nil rate band was, as it has been since 09-10, £325,000. So that will be a net CLT. Now it's July 2010. So we've already used the annual exemption from 09-10, but this, of course, 15th of July 10, is 1011. So we will therefore now be able to reduce the transfer of value by the annual exemption for the 1011 tax year. July 10 falls in the 1011 tax year. We've already used 09-10, nothing unused brought forward from the previous year. And the third and final one, and the pièce de résistance here in terms of the calculation, December 14, so that will be in the 14-15 tax year, gave 4,000 shares in Joe Limited to his son. Gift to the son, that therefore is pet. Prior to the gift, Joe owned 16,000 out of the 20,000 shares in Joe Limited. Now he's giving away 4,000 shares. Classic scenario for the transfer of value computation. Before the gift, he owns 16,000 shares out of 20,000. That therefore is 80%. So what will be the price per share for an 80% shareholding? He's then going to give away 4,000 shares. 4,000 away from 16,000 will bring you down to 12,000. 12 out of 20, that is a 60% shareholding, and that will be the price you use for the number of shares held after the transfer. So what number of shares before, what number of shares after at the relevant share prices. 16,000 shares before the transfer, 12,000 shares after the transfer, valued respectively on a basis of an 80% and then 60% shareholding. And of course, kindly, they give us the share valuations for various levels of shareholding. We need to pick the relevant ones for us. So, where do we start? In terms of computing IHT payable, either during Joe's lifetime or on his death, what we've firstly got to do is deal with this bit, the lifetime transfers. So I need you now to set up a working for chargeable transfers, such as we dealt with just a little while ago, back in illustration 10, I think it was there. There is your working for chargeable transfers. Now here, in the example we've got going, with example 1, we have seen that we've got in order a pet, a CLT, a pet. We know the dates, November 09, July 10, and December 14. Set up, therefore, your working for chargeable transfers with those 3 columns in order: November 09 for the pet, July 10 for the CLT, and finally December 14 for a further pet. We will then need to include within that working the transfer of value, followed transfer by any exemptions that may be deductible from the transfer of value to bring you down to the chargeable transfer figure. I would like you now to do that work. In getting the transfer of value on the third transfer, the second of the two pets, you will need to do a separate working for the transfer of value. How many shares before, at what price, how many shares after the transfer, at what price. Put in your transfers of value, then transfer by transfer, apply your exemptions. Marriage where available, otherwise annual exemptions to apply. And you know the order in which to do it. Do that working of chargeable transfers for me now, please. Okay, well, hopefully by the time you look at this, you've already done your calculation of the chargeable transfers, and your working is looking pretty much the same as the one that you see here. Headed up chargeable transfers, we need to record PETs and CLTs in chronological order: November 09, July 10, December 14. What were they? PET, CLT, PET. Transfer of value. First of all, of course, the figures as given from within the question: £40,000 for the first PET, £405,000 for the CLT. We then need to work out the transfer of value. Now you could show it here on the face of the computation or revert to working one for that. What have we got to do? Look at how many shares we held before the transfer. That we said was 16,000. 16,000 shares represents an 80% interest. How do you value shares based on an 80% interest? At £25 a share. So before the transfer, 16,000 shares at £25, that was 400,000 you should have computed. After the transfer, now he's gifted away 4,000 shares, so 4 out of 16. After the transfer, 12,000 shares remain. That is a 60% interest. How do we value a 60% interest? At £18 per share. 12,000 at 18, if you work that through, it comes to 216,000. Take away the value after the transfer from the figure before the transfer, and thus you get the transfer of value, and that figure I hope you got at £184,000. Then transfer by transfer, we look at any exemptions that may be deducted in deriving what will be our bottom line chargeable transfer figures. It is then those figures, the chargeable transfer figures, that will lead into the respective IHT computations, headed firstly lifetime transfers chargeable when made, and then lifetime transfers chargeable on death. We've already recorded on the question page what exemptions are available. For the November 09 PET, we had £5,000 of marriage exemption there. We then had our annual exemptions for 09-10 and 08-9, current year followed by unused amount for previous year, £3,000 apiece. Take away therefore the 5, the 3, the 3 from 40, 29,000 is the chargeable transfer. CLT, we're told the transfer of value on that one again at 405. What's available? Well, all we've got now is one annual exemption for 10-11, 3,000, take it away, 402. From the transfer of value for the shares there in December 14, the second of the PETs and the final lifetime transfer to deal with, we've got two lots of annual exemption. Again, note the order: firstly the current year, then the unused amount from the preceding year there. Take them away and you've got your chargeable transfer figure. So now you've got those chargeable transfers, where will we go? Firstly, check, do we have a CLT? Yes, we do. There is your CLT. That therefore took place in July 10, so we now, or you now, will set up a computation headed lifetime transfers chargeable when made. You will compute the amount of tax you will compute the gross chargeable transfer that arises in relation to that gift there into trust in July 10. Once done, we are then in a position to compute the lifetime transfers chargeable on death, what is the nil rate bound on death, and then deal with it transfer by transfer. The first pet in November 09, but that is only 29,000, and on that basis will be fully covered by the available nil rate band. The remainder of the nil rate band will then be available to go against the second of the chargeable transfers. Again, that of course may or may not be the gross figure. It depends on whether that CLT was paid net or gross, the tax thereon, and you've already got that result in your computation headed lifetime transfers chargeable when made. Once done, then we can move on and deal with the second of the two pets. No doubt at that point, of course, that there will be, in relation to it, no nil rate band available. On any of these calculations, of course, we then have to look out for taper relief, and in the case of the CLT, for a deduction for any lifetime tax paid. I would like, therefore, you to have a go at those computations based on what we've seen in the earlier illustrations. And at this point, we've reached a suitable point, as the recording is now getting quite long, to actually pause at this point in time. What I need you to do, therefore, is to do the two computations I've asked for: lifetime transfers chargeable when made, lifetime transfers chargeable on death. And once you have done that, then, well, pick it up the remainder of the answer to this question on the next lecture, and indeed what will be our final lecture together on IH2.